Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm here to help you maximize your cash flow. Today, there was a lot of questions asked in an email, and they were really good questions relating to some whole life illustrations that we're working with. And I thought there was a lot of value in sharing the answers with all of you. So let's take a look.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
All right, let's go through these questions as we go through this email. He says, thanks, James. These two make more sense to me. That was in response to a couple of Guardian illustrations that I had sent to him. So he says, I wonder how MassMutual or PennMutual stand out compared to Guardian. Oh, in my email where I sent the illustrations for Guardian, I also mentioned how depending on his needs, MassMutual or PennMutual could also meet those needs. So he came back with these questions. I wonder how MassMutual or PennMutual stand out compared to Guardian. What do they have to offer that Guardian does not? What provisions or riders are unique to MassMutual or PennMutual? If there are any, what does Guardian have that offsets MassMutual or PennMutual? And the next list of questions aren't necessarily specific to those particular companies, so I'm going to address those first, and then we'll move on to the other questions. So first he says, how does MassMutual or PennMutual stand out compared to Guardian? The biggest way that they stand out is the current dividend rate. Currently, MassMutual pays out a 6.2% dividend rate, and PennMutual is 6.1%. Meanwhile, Guardian's dividend rate has dropped down to 5.65%. Not a whole lot, but it can be significant because when we do illustrations, we're going to illustrate moving forward based on what the current dividend rate is. So when we do the actual figures, the projected numbers for MassMutual and PennMutual are going to be larger simply because they have a current higher dividend rate. Now we know over the last 25 years that MassMutual and Guardian are actually the top two averaging, and they've traded places a couple of times during that period as to who pays out the highest dividend. So I don't necessarily look to who has the highest dividend as the number one factor when we decide which carrier is going to work best. But dividend does play a factor in there, and something to be aware of is that PennMutual and MassMutual currently have very good dividends and historically have very good dividends, as does Guardian. Now, next question, what do they have to offer that Guardian does not? A couple of different things. PennMutual, let's start with PennMutual. PennMutual has one thing to offer that the other two do not when it comes to their whole life policies, and that is an overloan protection rider that PennMutual offers that I don't know any other whole life companies that do that. We typically see that available in index universal life, but not in whole life. So that's something unique that PennMutual can claim. Yeah, other than that, the things that both PennMutual and MassMutual offer is the ability to design the policies so that you can pay in 8 or 9 times more than the base premium for a long period of time, much longer than Guardian allows us to, potentially as long as you own the policy. So that can be a significant advantage. MassMutual and PennMutual both have that ability, and when it comes to long-term cash value growth, if you are able to make a commitment to contribute the high amount of premiums ongoing, then those can be a really good option. Where Guardian excels is with folks that are interested in just a very short funding period. 7 to 10 years is typically an ideal funding period for maximizing your cash value with a Guardian policy. Now, there's other reasons in there, and we'll be getting to that, but flexibility makes a big difference when it comes to choosing a Guardian policy as well. Next question, what provisions or riders are unique to MassMutual or PennMutual? The really unique rider I already mentioned when it comes to PennMutual is that overloan protection rider. Outside of that, you don't really have unique riders. There are different names to riders, whether it's an accelerating paid up addition rider or an enhanced paid up addition rider. There are a couple of different options in there when it comes to the PennMutual product. With the MassMutual product, they also have something in there. It's called LISR and AILR. And with both of those companies, MassMutual and PennMutual, it's because of those riders that we're able to extend the maximum contribution period to up to the full length of the policy. Whereas with Guardian, you just have your basic paid up additions rider where we blend term insurance with whole life. And there's definitely a lot of benefits to having access to those other riders within MassMutual or PennMutual when it comes to long-term being able to contribute higher amounts. And then of course the overall growth potential because of that. Next question, if there are any, what does Guardian have that offsets MassMutual or PennMutual? Good question. Guardian has the most flexibility when it comes to contributing premiums for the whole life policies. PennMutual and MassMutual are companies that want to know exactly how much you're planning on putting in each year. And they're going to use that when determining your eligibility. So, case in point, if you want to contribute $50,000 a year in premiums, and we design a policy where that's the max amount that you want to put in. They do offer flexibility that you can put in less, but you can't put in more than that without getting underwriting approval. Now, that means if you want to put in $50,000 a year, we need to tell them that you're putting in $50,000 a year. They may or may not like that. A lot of companies don't appreciate the infinite banking concept, and they don't appreciate the ability of folks to be able to put in large portions of their income into a life insurance policy. I think they're used to seeing clients who end up getting in over their head with bad policy designs and no cash value available, and so they commit to paying too high of a premium, and then they get in trouble. And then they end up closing that account because of that. So they will not approve that if that $50,000 premium is a significant portion of your income. Guardian, on the other hand, Guardian allows you the flexibility to contribute all the way up to the MEC limit on any given year. And you only have to commit to a base premium. So in this case, we can design the base premium of $5,000, and you can contribute up to $50,000 throughout the course of the year. So Guardian says, okay, they're only committing to $5,000. We will approve that, and you're welcome to put in $50,000, even if that's all of your income, because you're going to have that cash value available to you. You're going to be able to borrow against it. That's not why they have so much flexibility, but that's the result of the flexibility. So oftentimes we can get you approved for a policy that will accept a larger portion of your income if we go through Guardian than if we go through MassMutual or PennMutual. So something to consider. The other thing to note is that Guardian, when we apply for a certain death benefit, that's the amount that they're looking at when they try to determine, do you qualify for that much life insurance? With PennMutual, they're going to actually look out a few years at what your death benefit could be after you've been funding it for the amount that we've anticipated you're going to fund it at, and they're going to take that amount of death benefit. So while your death benefit may start out at $1 million, in 5 years that could go up to $2 million or $2.5 million. And they're actually going to use that amount to determine if you qualify to be able to put in that much. So interesting things, depends on which company you're going with, but these are things that we look at when we try to determine which company will work best for your situation. Now, let's move on to the next questions, and these are numbered, which makes it very helpful. Client says they're looking for how much cash value would be available relative to the monies paid. So among those three companies, typically in the first year, the cash value that's available with Guardian and MassMutual will be close to 90%. And with PennMutual, we can get you close to 80%. Those are typical monies available in cash value. Number two, how soon will the loan proceeds be available? Good question. And typically, after 10 days. Every client has a 10-day free look period where they can back out of a policy and get all their money back. So your insurance companies tend to wait at least that 10 days before they make the loans available to you based on the cash value. So I know from experience, MassMutual and Guardian are both available right at around that 10-day mark. Now, to actually get the money, it's a little bit quicker with Guardian because they can do an electronic funds transfer, whereas MassMutual will mail you the check. So things to keep in mind. Number 3, how often can I make a loan? You can make a loan as often as you want. These policies function like a line of credit. You can request a loan, take money out, and you can put money back in as often as you want to throughout the year. Number 4, flexibility in whether to continue paying into the policy or stop after a number of years, for whatever reasons. He believes this is the reduced paid up option. Correct, and that is available with all whole life policies. Now, the way to utilize the reduced paid up option is after 7 years. You can turn your policy into a reduced paid up policy at any point after 7 years. Now, you don't have to turn it into a reduced paid up policy just to stop contributing premiums. You can always just stop contributing premiums, and the cash value in your account can continue to pay that base premium that's being expected and the underlying cost of the whole life insurance, not counting the blended term. So that is another option if you wanted to just stop contributing. And they all have that flexibility. Now, on the flip side, there's some flexibility as to whether you can start making payments again. That varies based on the company. Some companies will look at your history of the last few years, and if you haven't been contributing the max amount to the policy, the maximum amount that you can pay in will end up getting reduced. So that's something to consider as well. Number 5, flexibility in not having to go through underwriting. That comes down to, I think I kind of addressed that a little bit, but Guardian has the most flexibility there, where you can contribute up to your MEC limit without having to go through underwriting. With PennMutual and MassMutual, anything above the planned premium, you will likely have to go through some type of underwriting in order to be approved for that. Now, on any of the policies, if you want to increase the amount of insurance, that will likely entail going through underwriting. If you want to reduce the amount of insurance, does not include going through underwriting. Number 6, if I go through medical underwriting, which one will be the least restrictive? I'm not exactly sure what that means, being the least restrictive, but when it comes to getting approval, PennMutual is probably the quickest one to get approvals. They've done approvals as quickly as less than 24 hours. On a regular basis, they can get them done in just 2 days, which is outstanding. And they've mostly moved to an accelerated underwriting process. So they're not even ordering medical exams for most of the clients these days. Guardian and MassMutual, different story. In order to get the approval, it takes a bit of time. It takes, 4 to 6 weeks probably. I've had it take 8 weeks on some of them. It just depends on how long it takes to get the necessary medical information to make a decision. But yeah, sometimes those can take a while. Now, perhaps you meant by least restrictive is which one is more lenient when it comes to different medical conditions. And in that case, I'm not exactly sure. They all seem to be fairly similar in that regard. I don't have any particular cases that jump to mind that have led to somebody being denied from one that they would have been able to pass with the other. And they say those are just some of the things they're seeking answers to. Do any of them have calculation features like Allianz to see how much you could safely withdraw, think monthly retirement income, without triggering a MEC, surrender policy, or surrender, policy lapse, etc.? I'm not familiar with them having that ability. What that refers to is most of your IULs. When we do an illustration for an IUL, it can automatically calculate what a possible safe income withdrawal would be in retirement. we can plug in, I know in Guardian, I can plug in specific numbers in there and see how that plays out. But I haven't seen a feature like the Allianz feature or any of the other Index Universal Life features where we just punch in a couple of numbers and it'll spit out an income stream in retirement. So I'll have to take a look and see if that is available with some of those other ones. Yeah, for the most part, it may just be something that I haven't really had to address yet. That's it for the questions. I hope that's helpful to you. I hope it's helpful for my client. And if you have any questions, you're welcome to send me an email. You can sign up for a meeting with me. There's a 20-minute free meeting that I offer to anybody. We can really talk about anything you want. Doesn't even have to be insurance. And you can do that at calendly.com/cashflowpro. The link should be in the show description, and I'll put it up here on the screen as well. So if you do have any questions, I look forward to hearing from you soon. And if you want to find out more about whole life policies, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.